Have you ever heard that dollar cost averaging, DCA, is the safest way to invest? Many people believe it's the golden ticket to financial success. But what if I told you that sticking to DCA could actually hurt your returns? Here's a shocking fact. Research shows that if you had invested a lump sum in the stock market over the past 30 years, you would have outperformed DCA nearly 66% of the time. That means those monthly contributions might be costing you money instead of saving it. In this video, we'll break down the myths surrounding DCA and reveal what most people don't know about this popular investment strategy. We'll explore the hidden risks of relying solely on DCA, compare it with lump sum investing, and discuss smarter strategies that can help you grow your wealth faster. Are you ready to challenge everything you thought you knew about investing? Let's dive in and discover the truth behind dollar cost averaging. Chapter 1. The dollar cost averaging myth. Uncovering the misconceptions. Many people believe that dollar cost averaging is the perfect solution for everyone. It's easy to understand. Invest a fixed amount of money regularly, regardless of the market's ups and downs. But the truth? DCA isn't foolproof. In fact, research from Vanguard showed that investing a lump sum outperforms DCA nearly 2/3 of the time in a rising market. Why? Markets generally go up more than they go down. When you invest all at once, your money has more time to grow. For example, over the last 30 years, the S&P 500 has averaged an annual return of around 10%. If you're trickling money in through DCA during a bull market, you're missing out on potential gains. DCA works best in highly volatile or declining markets, which aren't as common as people think. A 2012 study published in the Financial Analyst's Journal even showed that DCA is more of a risk reduction tool rather than a wealth building strategy. So while it's often marketed as the safe option, DCA may actually slow you down when markets are climbing. Chapter 2. The hidden risks of DCA. What no one tells you about timing and markets. One of the biggest selling points of DCA is that it eliminates the need to time the market. But here's the catch. Not timing the market doesn't mean you're safe from risk. Sure, you're reducing the risk of buying at the top, but you're also limiting your exposure when the market is climbing. In sideways or bullish markets, the gradual approach can mean leaving money on the table. Take this for example. If you had invested $10,000 in the S&P 500 index in January 2020 as a lump sum, you would have made a lot more by the end of the year compared to investing the same amount using DCA. In fact, by July 2021, the lump sum strategy outperformed DCA by about 8%. One unique risk of DCA that people rarely talk about is drag risk. This happens when your uninvested cash sits in an account earning very little or nothing at all while the market is growing. This can quietly erode your overall returns, especially during periods of strong market performance. Another overlooked issue? Inflation. The longer your money sits outside of the market, the more inflation chips away at its real value. DCA assumes that delaying investment can reduce risk, but it doesn't account for the fact that inflation steadily eats into your purchasing power over time. In short, delaying your money's entrance into the market can actually expose you to a hidden loss. Chapter 3. DCA versus lump sum. The surprising winner when lump sum beats DCA, and why you'd never expect it. Contrary to popular belief, lump sum investing, LSI, often outshines DCA in various market conditions, especially over the long term. When investing in a rising market, which historically happens more often than not, putting all your money to work immediately gives it more time to grow. A 2020 study by Northwestern Mutual showed that LSI outperformed DCA in 68% of scenarios when invested over 10 years. Here's why that matters. Markets generally trend upwards over time. Between 1926 and 2022, the U.S. stock market had positive annual returns about 73% of the time. While DCA allows you to smooth out your entry points, LSI captures more of the market's gains because your full investment amount is compounding right away. However, DCA does have one big advantage: it's emotionally easier. It's designed to minimize regret and reduce anxiety for investors who fear market crashes. But that's where it stops. If you're comfortable with the possibility of short-term losses, you might be better off investing a lump sum right away. As Warren Buffett once said, the stock market is designed to transfer money from the active to the patient. With LSI, you're being patient and letting the market do its thing. Of course, no strategy is perfect. Lump sum investing can feel risky if you're unlucky with timing, like dropping a large amount right before a market correction. But even then, the market's long-term upward trend tends to make up for short-term losses. For example, if you had invested a lump sum in the S&P 500 right before the 2008 crash, it would have taken only about 5 years to recover your losses, and you'd still be ahead today. If you're finding this information valuable, don't forget to subscribe for more insights into smarter investing strategies. Chapter 4. The Psychological Trap of DCA: How Comfort Can Cost You Big. One of the biggest reasons people stick with dollar cost averaging is because it feels safer. It's a strategy that gives investors peace of mind, especially when markets are unpredictable. But here's the twist: this sense of comfort can actually hold you back. Behavioral finance experts often talk about something called loss aversion. It's the idea that people feel the pain of losing money more intensely than they enjoy gains. DCA taps into this mindset by letting you avoid the anxiety of investing a large sum at once. You're not risking all your money in one shot, so it feels safer, but you're also limiting your upside. According to Jason Zweig in Your Money and Your Brain, the brain is wired to avoid pain more than to pursue pleasure. In investing, this means that strategies like DCA often feel like the right move, even if they aren't the most profitable. It's comforting to believe you're lowering your risk, but you might be sacrificing returns without realizing it. Here's the thing: by constantly waiting for safer entry points, DCA can create a psychological trap where you avoid taking meaningful action. It's a bit like being in a traffic jam and staying in the slow lane because it feels less risky, even when the faster lane is clearly moving ahead. Investors who use DCA to avoid market fluctuations are often more concerned with short-term risks than long-term rewards. However, the stock market rewards long-term patience, as evidenced by the fact that the S&P 500 has delivered positive returns in 73% of years between 1926 and 2022. This means that over time, staying in the game with more exposure to the market can actually be the safer choice. Chapter 5. A Better Approach to DCA? Unlocking hybrid strategies for maximum growth. So, if DCA has its flaws, what's the alternative? There's no one-size-fits-all answer, but a hybrid approach could be the solution. This involves blending DCA with other strategies to mitigate risks while also taking advantage of market growth. One option is dynamic rebalancing. In this strategy, instead of investing a fixed amount at regular intervals, you adjust your contributions based on market conditions. For instance, you might invest more during market dips and less during rallies, allowing you to buy low and sell high over time. According to a study by Dalbar, the average equity investor underperforms the market largely because of poor timing. A hybrid strategy can help correct that. Another interesting twist on DCA is the value averaging strategy, where you set a target growth rate for your investments. If the market performs well, you invest less. If the market underperforms, you invest more to reach your target. This technique, first introduced by Michael E. Edlison in Value Averaging, helps investors capitalize on market downturns without fully timing the market. By using these hybrid strategies, you get the best of both worlds. You still lower your risk, like with DCA, but you're also more responsive to market trends. This way, you're not just passively riding the market's waves, but actively managing your risk and reward balance. Chapter 6. DCA in today's market: outdated or essential? Is dollar cost averaging still relevant in 2024? As we head into 2024, the investment landscape has changed dramatically. With rising inflation, fluctuating interest rates, and unpredictable geopolitical events, many investors are questioning whether DCA is still relevant. The truth? It depends on your goals and the current state of the market. In a low-interest environment like the one we've seen in recent years, putting all your money to work at once has been more beneficial. As of 2022, inflation was hovering around 8.5%, meaning that money left on the sidelines, as happens with DCA, was losing value. On the flip side, during times of high volatility, such as the 2020 pandemic crash, DCA can help investors avoid panic and maintain a disciplined approach. A 2021 study by Charles Schwab found that investors who stayed the course during market corrections, including those using DCA, performed better than those who tried to time their entry and exit points. DCA forces you to stick with a consistent plan, which can be helpful when emotions run high. However, with advancements in technology and data-driven investing tools, newer strategies like automated portfolio rebalancing are gaining popularity. Platforms like Wealthfront and Betterment are using AI to automatically adjust portfolios based on market conditions, offering a more sophisticated alternative to traditional DCA. So, is DCA outdated? Not necessarily, but it's no longer the only game in town. In fact, a study from Vanguard suggests that as more sophisticated investment tools become available, traditional methods like DCA may slowly lose their appeal. But for those who want to keep things simple and stick with a strategy that works in a range of market conditions, DCA can still be a solid choice. If you enjoyed this exploration of investment strategies, subscribe for more insights and tips to enhance your financial journey.